on that one. We're going to go now to our next guest on fixed income and markets, Karl Schamota. Karl Schamota is Chief Market Strategist at Corpay. Karl, thanks a lot for joining us. I know you, like many Canadian investors, paid close attention to what Donald Trump had to say yesterday to the World Economic Forum. He referenced Canada a couple of times. Summarize what he said and what's your takeaway there? What kind of signal is he sending?
Yeah, it was amazing, actually. It seemed like Canada had become the U.S.'s chief, sort of geopolitical adversary, supplanting China. Lots and lots of negative, verbiage and rhetoric around the Canadian trade deficit or trade surplus, I suppose, with the U.S. Essentially a lot of rhetoric that might support putting tariffs on eventually. However, the fascinating part is the Canadian dollar, it did dip very slightly during his comments, but it did rally thereafter, suggesting that markets and investors more generally are not taking Trump at his word. They do not expect, anything too extreme from a tariff perspective. And as a result, are betting that the Canadian dollar could gain a little bit in the coming weeks.
He also said his message to corporations around the world was, come build your facilities in the United States and we'll offer you very low corporate taxes. Otherwise, we'll hit you and your products with tariffs if your products are coming in from abroad. How do you think that sounds to companies and governments around the world?
Yeah, I mean, I think it does raise the bar from a competitiveness perspective. It does suggest that many of us should, sort of clean up the house at home and ensure that our tax regimes are competitive to some degree with the U.S. But at the same time, I think that it is rhetoric again, because, the U.S. Congress right now, it is sort of poised on a very thin majority. Trump does not have the latitude to pass tax cuts on the scale that he did in his first administration. And so, we could see incremental changes. We could see a boost to U.S. competitiveness overall, but not to the same scale that was precipitated by the first set of tax cuts, 4 years ago. So, at the end of the day, this is a wake-up call, I think, for countries like Canada, which have not refined our tax code for a very long time and have not focused on increasing competitiveness. But it is not necessarily, the harbinger of a big slide in corporate moves to the U.S.
What's the appropriate Canadian corporate tax policy response here?
I think it would be to launch a commission to look at how to increase competitiveness overall. So, it's been many years since we did, sort of a top-down review of what our tax code incentivizes and what it doesn't, right? And so I think there are many good ideas out there. I don't know exactly how to balance those. I'm not a tax expert myself, but the reality is it's just simply been an extremely long time. Our tax environment and tax regime are built for a different age. It is time to take a look at that and to refine it and adapt it to where we are today.
Okay, the Bank of Canada next week will announce a rate decision on Wednesday. The market heavily betting on a 25 basis point rate cut. What do you expect? And I guess more to the point, what do you expect in some of the commentary that the bank will make in its statement and in its monetary policy report?
Yeah, I think markets are very much correct here in expecting that the bank will cut rates. Odds right now from overnight index swaps are pointing to like 90% likelihood of a 25 basis point cut. I do think that that's correct. We have a lot of slack in the economy. Inflation is running at or below target across most metrics. And the country does need some, insulation or a buffer against downside risks emanating from Trump's tariff threats. So even if Trump does not go through with his threats, the reality is that the uncertainty that has hit businesses and consumers in Canada is likely to slow the economy, all else being equal. So, I would expect that officials do talk a little bit about, those outside threats, those exogenous threats to the Canadian economy, but that they keep most of the commentary focused on, what the underlying inflation conditions in Canada are doing, and, helping to set the stage for a prolonged pause in the coming months. So, essentially what they're going to try to tell us is that they are going to take a wait and see approach after this move. And, if they do cut again, it will be very gradual and very, cadenced. It'll happen at a long delay over the months and years ahead.
Meanwhile, in the United States, the Fed is due to make an announcement in late January, actually the same day as the Bank of Canada, Wednesday of next week. No cut is seen by the market, almost a 0% probability of a cut. And the market isn't solidly convinced of a cut until the June 18th meeting rolls around. And our previous guest on this program this morning says he and his colleagues at BMO Global Asset Management are not expecting any rate cuts from the U.S. Fed in 2025 and perhaps a rate increase. What do you expect from the U.S. Fed in 2025?
Yeah, I mean, the fundamentals right now do not justify cutting rates again. The reality is that inflation has sort of oscillated around elevated levels. It is not showing signs of, falling dramatically. Meanwhile, other fundamentals in the economy, from the employment market to consumer spending to business investment, are all running on all cylinders. And so, it does make sense to wait and see at these levels. I don't necessarily think that we're going to see the conditions in place for a hike this year, unless we do see extreme moves coming from the Trump administration on the tariff front. And I wouldn't say there that, I would expect that tariffs dramatically raise inflation, but they could put upward pressure on inflation expectations and contribute to a rise in the price level. So what that might mean is that we see more hawkish rhetoric from Fed officials over the year ahead. So, if we boil all that down, that means that there is a differential between Canada and the U.S. from a rate perspective, but that it is likely to stabilize very close to current levels. In other words, we might see one cut from the Bank of Canada, or one or two cuts perhaps from the Bank of Canada over the course of this year, including, the January move, and one cut from the U.S. And so what that, really does is it sort of, firms up those rate differentials and does not in and of itself move the Canadian dollar.
Karl, always great to touch base.